This lesson is part of the price action series looking at reversals, and it's the second lesson on reversals. We're going to talk about the under-over and over-under pattern. These are sometimes incorrectly called a head and shoulders or an inverse head and shoulders. They look the same to the untrained eye, and a head and shoulders, for anyone who doesn't know, it looks like this, and an inverse head and shoulders looks like that on the screen. Now, there's a difference, which we'll come to in a second. The main difference is that the head and shoulders pattern, the very premise of it is that you have a neckline, which is where the trough before the final peak at the head, and then the second test of it, forms a neckline, and when broken, you take a short if it's head and shoulders. So you wait for the neckline to break and you short it. Or for an inverse head and shoulders, you wait for the neckline to break and you long it. Right? But the under-over and over-under pattern are different. And I prefer them to a head and shoulders because they include an all-important market structure break, which means the neckline breaks before the right shoulder is made. All right? Why is that important? Because that means we can enter at a better price due to the market structure break. Now, you know what a market structure break is from previous lesson that we did on market structure, but let's cover it again briefly, and then we'll get into the under-over and over-under pattern. So here is a bullish market structure break. In a bullish market structure break, you can view it either through candlesticks or line chart, but you're going to need candlesticks, and you'll see why in a second. You find a market structure break by looking backwards. So the easiest way to find the market structure level is to use the line chart, and then flip it back on to candles. For a bullish market structure break, you have to wait for a low to form. So this is one of the most common questions from students that are confused about how to spot it. They feel like they have to spot it ahead of time. You don't. You wait for multiple red candles and a low to form, and then for price to go above that low, so it looks like it might be a bottom. Nothing confirmed yet, but it might be. At that point, then you look back, where was the last green candle, the last up candle, before this low? And you mark your line across the candle close. Hence why doing it on a line chart gets you the exact level. The market structure break itself is the next time a candle closes above that level, on the same time frame, of course, you have a confirmed market structure break. All right? And the reason we use the last candle close of a green up candle to find the MSB is because it represents the swing high of the previous move. Swing high into a low, we then break above that swing high, and for anyone who's seen the market structure lesson, which should be everyone, where I talk about swing highs and lows, you'll understand exactly why that is so important. Quickly look at a bearish one. It's the same thing, obviously in reverse. Again, you find a market structure break by looking backwards. You wait for a high to form, and then you wait. You see the high, this long wick. You see this next candle failing to go higher, and you think, this could potentially be a top. Nothing confirmed, but that doesn't matter yet. I'm going to go back. Here's a red candle. There's the close of the candle. I draw my market structure line across that, and then the next time a candle closes below that level, on the same time frame, it's called a market structure break. Again, line chart view, you see the swing low. When the swing low gets broken, that's a high probability reversal. So that's a refresher on market structure break. Now let's look at how a full under-over and over-under form. So let's look at the under-over. First, you might wonder why the name. Why is it called an under-over? Well, that's because it goes under the low and then over the market structure high to complete the pattern. So on this line chart, we have the market structure level in dashed red. We have the low in solid red. So for an under-over to form, price goes underneath the low, it then comes back up and it goes over the market structure break level to shift the trend and give you a high probability reversal. That's simple. So that's the name. So why does it work? More important than the name. Regardless of the time frame you trade on, the principle of an under-over or an over-under is the same. It's psychology. You have trapped traders, a high probability trend shift, and a retest. So let's look at that. The under-over obviously reverses and causes a bottom, and it works by trapping traders. So first you set a level. So price comes down and it sets a level. Then price drops below that level, trapping some traders, which is confirmed when it comes back above the original line and then closes above the market structure break level, which indicates to smart traders, like all of you, that there is a high probability that the trend is changing. That part, the number 3, shift the trend, that will indicate to anyone who trades with price action principles to not short this and to potentially go long. So it becomes self-fulfilling. It follows up with a successful retest of the first low, and that is your confirmation of control shifting into the bull's favor in this case, and price going up. All right? You see here, if you view it as the inverse head and shoulders, if you want to use that frame, you have your left shoulder, head, and then the right shoulder. Okay? And this part is a left shoulder retest. So if it hits the red line, it's retesting the left shoulder level. Doesn't always hit it, of course. And you need to look at it on the candlestick chart as well as the line chart. So here's the exact same under over, right? Exact same one, but it's on a candlestick chart, and you'll see that it's slightly different. And this is important. So the low at point number 1 is drawn from the wick instead of the candle close. So previously it was candle close. Now it's drawn from the wick. I personally prefer to use wicks for the lows because the whole point of number 2 is to trap traders, yes? If you're going to trap traders, you want to do it below where their stop loss will be. Stop losses don't get placed on candle bodies. They typically get placed below candle lows. So I always use the wicks for the lows or the highs in the inverse. But always use the candle close for the market structure break, because this indicates more strength in the reversal than just a wick. You understand that from your previous lesson on market structure and why the swing high must get broken. So very simple, candle bodies for market structure break, candle wicks for your lows and highs that create the shoulder, head, shoulder, or the under over completed pattern. And there you have your 1, 2, 3, 4, which are the principles that I showed above. You set your low, you trap traders, you break market structure, and you retest, and there's your completed under over on a candlestick chart. Now, let's look at an over under. As the name suggests, it goes over the high, and then it goes under the market structure level to complete a structure break. So again, we set a level, this time a high, we trap traders above it, we shift the trend by breaking below the market structure level and closing, and we retest for confirmation that control has shifted into the hands of the bears. Another left shoulder retest. So this works exactly the same as the under over, and I've just shown you it in the inverse. So exact same principle as tops at bottoms. Successful retests of the left shoulder happen, but not always. And don't expect them to be perfect. That's one important thing to note at this point. You'll notice on this one, even on the line chart, price goes slightly above the red line. And on the one before, price didn't quite touch the red line. I use those examples for a reason. It is not supposed to be perfect. Don't get hung up on it touching the line perfectly. And do not just automatically set orders at those levels, as you'll see why in a moment. It is not supposed to be predictive. You still need to wait for confirmation, retest to show control. And so this is the exact same over-under on a candlestick chart, but there are some important differences. The retest of the previous high, the left shoulder retest, has a wick which goes above number 2. So that would have stopped out any traders who had got in too early and put their stop above there. It's important to keep this in mind. Now, this is the exact same structure. You set the high, you trap people, you break structure, and you have a successful retest. But there was also a long wick here. Important. Never, ever try to guess the pattern. You must wait for confirmation of the retest with a candle close. So if you exercise patience and simply waited for this candle to close, you would have seen that it was totally valid. The candle close was below the original high, and you could have entered easily there and had your valid over-under pattern.